Hello, everyone, and thank you for joining us for the Griffin Partners live webinar and Q&A session with CrowdStreet. My name is Reed Llewellyn. I am the Investor Relations Manager here at CrowdStreet. I am pleased to have Edward Griffin, President, Andrew Montgomery, Executive Vice President and Head of Acquisitions, and Kevin Ellis, Associate, to discuss the Union Woods offering on the CrowdStreet Marketplace. After the short presentation, we will open it up for questions. Please note that all investors are in a listen-only mode. If you have a question during the presentation or the Q&A portion, please type it into the questions box and I will ask it on your behalf. Before I hand it over, just a few housekeeping items. Please, everyone, note that the Invest Now button is now turned on as of a couple seconds ago. If you need to refresh your screen for all investors listening in, please do so. And please note that the offers due date for this project is June 5th and funds due date is June 10th. And with that, I'll let the Griffin Partners team take it away.
Thank you, Reed. This is Edward Griffin. I'm President and CEO of Griffin Partners. We are very pleased to have you join us today for this webinar to discuss Union Woods. This will be Griffin's fourth offering on the CrowdStreet platform. We're very pleased to be able to continue our relationship with them. And we are going to be presenting today the Union Woods office building in Salt Lake City, Utah. With that, I'm going to turn it over to Andrew Montgomery.
Thanks, Edward. This is Andrew Montgomery with Griffin Partners. And I'm excited to go through the Union Woods office project. And as Reed mentioned on your screen, I'm going to summarize the overall investment. And as I go through the summary, Reed will scroll down and follow along with my comments as we summarize this exciting new investment for us in Salt Lake City. So as Edward mentioned, this is our fourth investment on the CrowdStreet platform. We have been in business since 1980, been in this acquisition business really since the late 1990s. We currently are investing our Griffin Partners Office Fund 3. This is our third fund in a series of funds. This will be our 12th investment in that fund, and we are committing a little bit over 50% of the equity to this transaction, and through the CrowdStreet platform, hope to raise approximately $4 million in the investment. So with that, we currently have about $600 million of assets under management and have had tremendous amount of experience in managing, operating, and owning office investments in the southwest and western part of the country, as well as the southeast. So on that note, I was going to turn it over and discuss specifically the deal and the high-level deal points, and then scroll down, if you would, Reed, to the key deal points. Obviously, Griffin Partners has a fair amount of experience in the office ownership and management. We're not offering any acquisition or disposition fees or catch-ups for this investment. This is an investment that is a pari passu offering with a 1% asset management fee, and there is no promoted interest that will be charged to the investors. Salt Lake City is a market we've been covering for 3.5 years, and this investment is an exciting first entrant for us into the Salt Lake City market. It's an excellent location, in our opinion, in Union Park Submarket, just west of Cottonwood Heights, one of the leading suburban submarkets between Union Park and Cottonwood. This building is by far one of the best redeveloped assets in its competitive set. The overall market strengths are strong, vacancies are low, and the recent tenancy to the building provide a core plus investment. Through that core plus investment, we have a strong cash on cash during a hold period, and we have layered in favorable debt terms with a relationship lender east-west bank, and we are purchasing the asset at well below replacement cost at approximately $235 a foot, or $23.3 million. So scrolling down to the investment itself, as I mentioned, it's in the Union Park submarket. Its current average vacancy in the comp set is approximately 4%, and is average single-digit vacancy over the last 10 years, which in our opinion shows tremendous amount of intrinsic demand and appetite for leasing space in this submarket. The location is excellent on the corner of Union Park Drive and 1300 at a lighted intersection. It is a excellent access, ingress, and egress in and out of the project, and very much a walkable project to many retailers within the area.
Including Starbucks, which is right across the street.
Across the street. Overall access to the project is minutes from in all directions. It's about a 15-minute drive from the airport. It faces due west of the Wasatch Front and is on an elevated site, so therefore it has excellent views to the east, west, well, and actually in all directions. Starting on the second floor, the views are very strong. Further, regarding the location, we believe this area provides a huge amenity base for various types of retailers, from Whole Foods, Trader Joe's, a Super Target, a Super Walmart, various food establishments such as Wings, Buffalo Wild Wings, Chili's, Denny's, all types of different retailers, from UPS to FedEx, very much an infill location in providing all the rooftops in the area in this strategic corner on Union Park in 1300. So moving along from just overall location, wanted to talk a little bit about the story of the asset. If you scroll down to the business plan, this asset we are purchasing from Hines and Oak Tree joint venture. They purchased the asset in late 2015 from another institutional owner, Griffin Partners. They purchased the asset at 90+% leased, with a known vacate of a full floor tenant and a few other tenants that were leaving the project, one for a new build-to-suit project south in the Draper market. They purchased approximately for about $186 a foot and have invested over $2.5 million into the project since they purchased it, updating the lobbies, common areas, exterior facade. They've increased the size of the building by approximately 9,000 square feet on the first floor, adding new windows, etc. They've updated the common areas in the restrooms, and through that redevelopment plan have taken this asset from, in our opinion, a B building to maybe a B+ or A- asset. And through that, they've accumulated a very strong tenant roster and taken the building back from 70% leased in a very short period of time to 91% leased today. So some of the light value add or the core plus type of investment that this is, but considering the amount of dollars that have been invested to date, we have some additional capital improvements to enhance the tenant experience. Patio seating, bike racks, updating a few different restrooms. We are replacing the roof, doing various updates, light value add, if you will, due to the tremendous amount of capital to this point on the deferred maintenance as well as the asset itself. It's very few things that we're going to improve, but would be an enhancement from the tenant experience.
Patio overlooks a nearby creek as well. It's a few yards away. It makes for a nice outdoor amenity, which doesn't currently exist.
So going to the overall returns of the asset, considering it's a core plus investment, we've solved for a 5-year hold period, primarily due to the staggered lease rollover. The average weighted lease term of the project is 3.5 years. The 5-year hold target is projecting approximately an average cash on cash of approximately 7.7% return and an overall target investor return of just under 15%, and an equity multiple during that period of time of 1.8x. We think these types of returns are achievable considering our initial basis and future exit. We've also planned through our loan structure that we have a 5-year lease term and 5-year loan term with 2 one-year extensions. So if the capital environment is not in a position for us to sell in 4 or 5 years, we have the option to extend our loan 2 additional years for a total loan term of 7 years. During that period of time, the increased cash flow through the investment should enhance overall cash on cash greater than 8%. Our loan is actually with an existing lender. This will be our second loan with East West Bank. The overall interest rate is a LIBOR plus 195. We're actually buying some insurance, a costless collar, during the initial 5-year term of the loan to hedge against any interest rate risk during the hold period. It's an interest-only loan, and we also have additional good news monies within this loan amount of $17.25 million. The total proceeds at closing will be approximately $14.5 to $15 million, and we have just the difference between that initial loan closing and the $17.2 for approximately $2.8 million to utilize to re-tenant and use for tenant improvements, leasing commissions, as well as the capital plan that we've summarized here within the project offering. The distribution strategy is a monthly distribution, and we provide quarterly updates. And here on the screen, you see an example of a capital commitment in your distribution. We want to talk a little bit about overall lease and our assumptions on the leasing, which I don't think are detailed here, but if you scroll down, business plan, property, floor plans, tenants. If you want to click on the tenants, the 3 major tenants in the building are Michael Baker, which is a tenant that used to be across the street in the Union Park competing buildings. They were in that project for 18 years. They recently left to this project to occupy an entire floor. And also Wex Bank and Data2 Logistics are also major tenants. These 3 tenants are all new to the building in the last 2.5 years and have all been provided tenant allowance to re-tenant their space in top condition, new LED lighting, new ceilings, new corridors, etc. on each one of their floors. Data2 Logistics is the most recent deal done, and its start rate was over a year ago at $26.50 gross. Wex Bank is a similar situation, as well as Michael Baker, in terms of their in-place rents. One key question that everyone seems to want to know is obviously how is the rollover profile of the asset and its overall cash flow. Each tenant expires in a succinct year in 2021, 2022, and 2023, providing investors a stable cash flow stream. And through our underwriting, we've assumed the following in terms of their rollover profile. Wex Bank, we've actually, at their end of their term, will be paying approximately $30.25 gross, and they expire in 2021. We've assumed they release their space at a lower rate of almost a 5% decrease. Michael Baker, who expires in 2022, who is the largest tenant, it's basically an indifferent increase of about 1.9% increase in their rents from $29.50 to $30. Data2 Logistics, we've shown actually a decrease in their rents in 2023 of $32.28 at the end of their term, and we renew them at approximately $31. So on average, the 3 major tenants we're effectively assuming, if you average all those together, is about there is really no growth in their rental rates, which we think we can obviously meet those objectives, but most likely outperform, considering each one of their spaces are brand new, and with the improvements to the project through our tenant interviews, which we can't underwrite, in meeting with each one of these tenants, are very happy with the building, the new lobby renovations, elevator modernization, as well as the updated corridors to the asset. One in particular tenant, Michael Baker, has, during our tenant interview, mentioned that they would like to take on more space, and for that might show an interest in extending their term early. Of course, we can't underwrite that today, but that's a very positive discussion currently with the existing largest tenant in the asset. One other important point here is if we go to the overall site plan, just 2 tabs over, Reed. You were just there.
Same set of tabs, 2 tabs over. There we go. Thank you.
You will see that as a part of the sale, Union Woods office building, the Lot 2 owner, which is Hines, is planning to develop a multifamily project. If that multifamily project is developed, it triggers a right by the Lot 2 owner to build a structured garage at no cost to us as investors in Union Woods for a 250-space garage, of which over 170 of those spaces will be covered, providing great amenity for our tenants at no cost to us as the ownership of the building.
So just to be clear, that's an obligation of the Lot 2 owner if they build the multifamily project.
Furthering that point, if a multifamily project is not developed, there is a perpetual access to the existing parking area in perpetuity that travels with the title of the property for access and parking for all the tenants of Union Woods to park on that surface parking lot presently. And that will not change so long as the multifamily project is not developed. Said differently, if it is developed, our parking ratio will be unchanged as well by adding the future parking garage at no cost to the ownership. We have an executed legal document that provides for these requirements in a development agreement, a completion agreement, as well as conceptual plans with the city of Midvale that oversees the deed restrictions of development in the project in the area. We think this, and long term, if Hines were to develop this project, will add future amenities such as multifamily as well as some retail to the project, and also enhance the overall value of this project, making it a complete mixed-use type project.
So just to reiterate and be perfectly clear, at the risk of being redundant, if the multifamily project is developed, the new garage will be constructed at no cost to the Union Woods office building ownership. We estimate the cost that Hines will incur to build the garage for the office building is about $5 million.
So back to the business plan of the asset. During our ownership, obviously we plan to be proactive in releasing the existing tenancy, reaching out and proactively marketing the building with the 2 existing vacancies, one on the first floor and one on the second floor. Our underwriting shows that we are only leasing one of those 2 vacancies. So we think there is upside to lease, and that vacancy we do not lease is on the first floor, although we've seen a fair amount of interest from existing tenants, as I mentioned earlier, that would like to take the space. Further, through our, as I mentioned, our tenant interviews, and then also the optionality if there is a development that would occur with the multifamily project, would provide future covered parking at no cost to our ownership. Reed, we also have done a risk analysis, which is not on this screen, but we always do a risk analysis, which is a thing we do for our investment committee internally, as well as for our investors vis-a-vis CrowdStreet. And we look at capital market risk, we look at rental rate risk, we look at overall vacancy risk in the project, and then hope to see what the results are if under what we like to call a doomsday scenario. If you'd like further discussions or information on that, we're happy to share. But the upshot of that doomsday scenario, if cap rates go up by 50 to 100 basis points, rents drop by $2, and overall inflationary rents go to 0% over our hold period, we're able to achieve at least a 1.1 multiple and a 9% total return. Again, if a number of things have to go wrong for that to occur, but for downside protection, we always like to make sure our equity is secure. Reed, I don't think we had anything else to add. We're happy to open it up for questions through the webinar. I see there is a number of people on the webinar today, which we're thrilled to see. We've had lots of questions over the last 48 hours regarding the investment, and we're happy to continue answering questions as we have the offering open.
Great, thank you, Griffin team. Let's begin the Q&A portion. We do have questions coming in. First one I want to address, if you're interested in submitting an offer in this project, the Invest Now button is now open. This is the page you will be taken to once you click Invest Now. There are 4 steps in the funding. We had a few questions come in about if investing through an IRA. The Griffin team and CrowdStreet are able to have investors fund through self-directed IRAs. If you are not one of the preferred partners, please, under account type, choose individual account to move forward and fill out that information. Next question that we have coming in is in regards to the distributions and starting. You did cover this, but I'll go to that page if you wouldn't mind just chatting about distributions, as well as for tax purposes, how they can plan to have depreciation be included.
Sure, I'll tackle that. This is Edward Griffin speaking again. As we do with all of our individual investment properties that we have offered on CrowdStreet, we make monthly distributions, typically near the end of the month. We can do it, we prefer to do it by ACH, but we actually have a few folks who still like to get paper checks, so we're not opposed to doing that as well. This particular project, we anticipate will have distributions during every month of our ownership. And as Andrew mentioned, we're expecting just below an 8% cash-on-cash yield. So there is, as previously mentioned, a 1% annual asset management fee, and it's 1% of contributed capital. We actually deduct those quarterly from the distribution for that quarter. So 4 times a year, the distribution will actually be net of that quarter's asset management fee, so 1/4 of 1% at that point in time. With respect to depreciation, and obviously we do not provide tax advice to any of our investors. We want to be clear about that. However, I can tell you that for a property with this profile, we will actually obtain a third-party cost segregation analysis, which will allow us to maximize depreciation and front-load it in the early years, which really are the 5 years of our projected ownership period. And as a result, it's very likely that the amount of depreciation will offset any income prior to depreciation, and therefore investors will likely actually show a loss on their K1 in terms of net rentable income. Obviously, the distributions are positive, so in effect, you get a deferral effect, subject, of course, to the depreciation recapture provisions, 1231, Section 1231, when we go to sell the property in year 5.
Great, thank you very much. I want to just add on to that for investors who are new to CrowdStreet on the call. If you follow my cursor, you'll see Marketplace, Transactions, Portfolio, and Documents. you'll be able to view the K1 tax document through the portal, either in your portfolio view where you can track the progress of the investment, your distributions, as well as in the aggregate view under the Documents tab.
I might add,
All right. Go ahead.
We have the goal of getting our K1s out by March 15th every year, and we were successful in meeting that goal for all of our CrowdStreet investors this year.
That's awesome. Thank you. Next question, is the building LEED certified?
The building is not LEED. We will obviously try to achieve LEED certification during our hold period, and I think with the recent improvements, we're able to achieve that, likely at the initial level of LEED Gold.
Great, thank you. Next question is in regards to cap rates. If you could just discuss the entry cap rate as well as the exit that you're projecting.
Sure. The in-place cap rate is approximately a 7.3% going in yield on the investment. Primarily, we think this slightly higher cap rate than normal is due to the complexities of partnering or having the multifamily development as well as a potential garage construction to occur if it was to develop on the site. Therefore, there was a slight, I guess, discount, if you will, to the cap rate. We like that optionality, and we like that slightly higher cap rate comparative to other market trades. Other market trades in the market, based on our sales comps analysis, is approximately 6.5% to 7%. And upon our sale of the asset, we're assuming a 7.15 exit cap at this point, which is, we think, above the average cap rate in today's environment in Salt Lake City.
I might point out that is a capping of the year 6 NOI, and so there's actually a spot on the presentation materials here and the posting materials where it's a little bit confusing because it shows that 7.15% cap rate but it shows it below the year 5 NOI. The year 5 NOI is still impacted by free rent and downtime in our underwriting from the renewal of that third large tenant during that year. And so the NOI for the 6th year, which is the year being capped on exit, is actually about $300,000 higher, I believe.
Yeah, it's a stabilized NOI versus, as you mentioned, the free rent that occurs in year 5. It's about $350,000 higher.
Great, thank you for the clarification. We're getting a few questions in regards to project versus investor level returns. If you wouldn't mind just helping CrowdStreet investors listening in the difference. I've brought up the part of the offering detail page that helps describe this.
Sure. The simple difference is the asset management fee charged during the term of the investment,
which is 1% per annum, and that's why you see the kind of 0.9% difference in the almost 1% difference in the IRR, the spread there. If you click on the fees just to the left for 1 second, Reed, just to reiterate, we mentioned this earlier, but I just want to reiterate, we do not charge acquisition fees. We do not charge disposition fees. There is no development fee here. If the garage gets built, that's not on our nickel. We're not charging any kind of construction management or development fee for that. The only fee is the 1% annual asset management fee, which you see there. And now if you click back on the prior tab to the right there, Reed, you can see the impact that it has. It's about 1% on the IRR, and it's exactly 1% on between the project level cash on cash yield and the net to investor cash on cash yield.
Great, thank you. And lastly, while we're in this section, we're getting a few questions in regards to capital calls. If you could just help clarify that language that's listed.
Sure. So the structure is a limited liability company, and there is an LLC agreement. Those documents are available and to be reviewed. If you click under documents, and what you will see there is that if in the event there is a capital call, which we do not anticipate, but we have to leave that optionality open, no investor is required to make that additional capital call. We would not expect there to be any. The project is well capitalized, relatively low leverage, and as Andrew pointed out in his remarks, we actually have $2.8 million in additional debt proceeds that can be drawn under the loan to cover capital costs associated with renewing the tenants in terms of the tenant improvement costs and the leasing commission costs. So with a strong positive cash flow, relatively low leverage, and additional debt proceeds available to cover tenant renewal costs, we are highly confident there will not be a need for a capital call.
Thank you for clarifying. Next question is in regards to just office supply in and around the MSA here. Could you just speak to other office buildings that are nearby and why your confidence in how the building can sustain these high lease rates and low vacancy rates?
Sure. As I alluded to or mentioned in our brief summary, the historical occupancy or vacancy rate in the competitive set, which is roughly about 1 million square feet of projects, is roughly 4% vacancy today. There are currently no projects under construction, and based on our information, we're not aware of any new projects coming out of the ground for development. The most recent project that has been developed, called Union Heights, which is at the second to bottom of the screen, was the latest project delivered over 10 years ago. And the current quoted rental rate, that's actually incorrect. The current quoted rental rate for that project is $29.50. They're currently doing deals just below that at $29 gross full service today. I would say that the building has performed very well if you're in terms of the competition and where its rental rates are and relates to its competition. If you'll notice, just the 6 buildings across the street is called Union Park. There's 1, 2, 3, 4, 5, 6, 7 of those buildings actually that were started development in the 70s, and the latest building was built in 1996 in the Union Park buildings across the street, or 97. I would just inform you that those buildings in that park, none of the updates that Union Woods has seen in terms of new lobbies, new corridors, new restrooms, that has not occurred in any one of those Union Park buildings. They're all original lobbies, all original restrooms, and frankly, because of that, Union Woods has been able to outperform, even though with surface parking, at better rental rates than its competition.
Great, thank you. Next investor question is in regards to parking. You discussed the structure that may be constructed. The question is around where would tenants park during construction?
Great question. Just so you know, that a garage construction of this size will take about 6 to 9 months to construct. And as a part of our agreement with the Lot 2 owner, they're legally required to provide convenient and adjacent parking to the project. If you look to the northeast of the project, there is a building called the James Campbell Building. They have a garage next door. They are currently working on an arrangement to have parking adjacent to their building, which is effectively no difference in the walk time, but to the front door of the building. So that is a requirement that the Lot 2 owner has to provide those spaces in lieu of the garage being constructed.
Can you go down and click on the map for a second, Reed? We can demonstrate that.
Yeah, scroll up. No.
There's a tab that has you were on it earlier and you kind of backed out. It's a location.
Yeah, the amenity map. Yeah.
Or just right there. There you go. No, that one.
Actually, it's on that page. But go back to nearby amenities.
Well, here, hang on. If you click click on the satellite image.
Nearby amenities. Just click on nearby amenities, please. You see just to the left or northwest of Union Woods, there's a structured parking garage with currently no, this was maybe taken on a Sunday.
The U and the N and the I of Union are on top of the garage.
So that's where the additional parking will be provided as of today as the garage would be constructed.
Great, thank you for clarifying. Next question is in regards to previous raises, previous projects that you've had on the CrowdStreet marketplace. For all investors looking on, you can see the sponsored marketplace history here. The Griffin Partners Office Fund 3, as well as Union Plaza and the Zachary building. If you could please just go into more context into how those projects are doing.
Sure. The Office Fund 3, which will actually be the majority investor in this transaction, this will be its 12th investment. It has $51.1 million in total capital committed to it. When this transaction closes, it will have deployed a little over $30 million of that $51 million in capital. It is paying quarterly distributions to all of its partners, including those that participated through our CrowdStreet offering. Its current quarterly yield is about right around, trailing 12 months, it's right around a little over 5%, trailing 4 quarters, I should say. And it has until March 31st of 2020 to finish deploying its remaining unallocated capital. And we expect that in the end, it will own about 17 or 18 assets, interest in about 17 or 18 assets, and it targets net to investors about a 15% IRR, about a 1.8, 1.9 multiple, and about a 7 cash-on-cash yield over its 8-year history, which is about 2.5 years into. Union Plaza, which is a little bit confusing because we'll now have two CrowdStreet offerings that both start with Union. Union Plaza is a mixed-use office over retail project in West Denver that we acquired in December of, what did it say on there? I'm sorry, April of 2018. Yeah, Zachary's December, and it is currently making monthly distributions at a rate of about 8%. And it is over 90% leased. Retail is 100% leased, and the office is mid-80s leased for an average of about 94 or 95% leased. And the last offering was the Zachary building in San Antonio, Texas, and we acquired that in December of last year, and it is 100% leased to a single tenant at the moment. That tenant is an expected vacate in 3 years, at which time we anticipate backfilling the building with probably making it a multi-tenant building, so backfilling it with more than one tenant. Because the tenant was an expected vacate, it was acquired at a 10.5% roughly cap rate, and so its cash distributions at the moment that it's making monthly to the investors is approximately 9%, and then we are also squirreling away a significant amount of cash flow in addition, so that we'll have a couple $1 million in the bank when that tenant moves out. In addition to that, we have about $3 million from the lender, so we'll have over $5 million to re-tenant that building when the tenant moves out.
Great, thank you. Next question is in regards to how was the deal sourced, this project, as well as the exit plan. You spoke a little bit about this. Just go into a little bit more detail for investors maybe who just joined the call as to potential buyers that you foresee could be a good fit for this asset when you're completed your strategy.
Sure. So CBRE Salt Lake was the listing broker. It was a widely marketed project. They received a number of offers. We obviously were the winning bidder, primarily not just because of price, but because of our certainty of close and because of prior history with the ownership. We have purchased in Fund 3 another Hines joint ventured asset. It was one of our first investments in Fund 3, and we purchased from Hines. This would be obviously our second investment within Fund 3 with the same type of ownership. So we had a track record with the seller that we could perform. So therefore, it placed us in a very good position as a quality buyer. In terms of our disposition strategy, as I articulated earlier, we plan to have a proactive leasing strategy, lease the remaining vacancy, and do our best to have some early renewal discussions with the three major tenants and extend their leases. And upon that period of time, over the next 3 to 5 years, if those leases are executed and extended, we'll, as always, we on a yearly basis look at buy and sell strategies. And assuming we renew all three, we would likely sell the asset to another stabilized core type buyer in that mid-low 7 cap range.
Thank you. Next investor question is back to the parking structure. Just to clarify, so if the parking lot gets built, are limited partners owners of this, and if so, how will that impact the returns of this deal?
There is no impact, as there is no cost associated with our ownership to construct the garage. We would just now have fee simple ownership of a freestanding new garage adjacent to the project that is within the title and meets and bounds of our ownership.
Right. So to be clear, Hines is building or would build the garage on our land. So that's why we have a development agreement with them. We have several documents actually, but the key document is the development agreement with them that dictates the size and nature and quality of the structure to be built on our land, which we would have 100% fee title to once it's complete. What I would add actually to what Andrew said is that while we didn't underwrite this, our view, and he touched on it a little bit in his summary remarks, our view is that adding a $5 million structured parking facility to this asset would likely enhance the value upon exit, and that would be reflected probably in a lower cap rate because the property would now be would have a structured parking as opposed to surface parking, as well as being adjacent to a brand new multifamily project, which really kind of would complete the nature of it being in a mixed-use environment. It already sits nestled amongst not only other office buildings, but as we pointed out earlier, a number of retail amenities, and now would have multifamily resi right next door. So it would truly be an office asset nestled into a mixed-use environment. By the way, there's a great picture of the creek that I mentioned earlier for those that were on the call, and you could see there's a little outdoor area that's kind of tucked under the building. If you follow the sidewalk up from the bottom of the screen and to the right along parallel next to the building, and then you see where it turns left, that's an open area in there that is covered by the envelope of the building, and that is the location where we expect to create a little bit of an outdoor amenity that tenants can enjoy while listening to the babbling creek nearby.
Great, thank you. Next investor question is in regards to property management. Given that you are based in Texas and this project is in Utah, could you just describe how you plan to manage this property?
Yes. Griffin self-manages all the properties that we have ownership interest in, and that includes properties presently in Denver, Phoenix, Dallas, San Antonio, Houston, Raleigh, and soon to be Charlotte. So we have significant experience managing properties outside of our home market in Houston. We have seasoned senior resources here in Houston that take the lead in terms of lead responsibility, and then we hire locally on-site tenant relations, engineers, and property manager or assistant property manager level individuals to manage, to handle the functions that are required locally. And we'll do the same here. We have a senior manager in Houston who's responsible for the western region. We have another senior manager who's responsible for the eastern region, and then one for Texas as well. And we have a fairly sophisticated business enterprise software system that we use to track, manage, and communicate with all of our team, regardless of their geography, including our back office team, which is overseas.
Great, thank you. Next investor question is in regards to a more general question, I would say. With more and more technology being infused in offices and companies, what is your view, in the next 5 years, given remote workplaces, and how that may affect the demand for offices like this?
Good question. Something that we're all always thinking about as operators and owners of real estate office buildings, as well as industrial buildings. There are obviously new technologies that allow different work hours, different work environments. Being in this type of location with retail amenities as well as the access with the national and regional credit tenants in the building currently with fairly long lease terms. Obviously, that could change over the next maybe decade, but I don't see that changing over the next 5 to 6 years. But it's a very broad question, so it's difficult to answer in succinctly in a couple of minutes. But we feel positive about our investment. One thing that we key on, considering where we are in the cycle of the U.S. economy, being a late cycle investment, we key on weighted average lease term, which we would categorize as WALT. In this particular project, we want a longer WALT than, say, a 1 or 2 year weighted average lease term. This has a 3.5-year WALT. Therefore, if the economy slows, we've got enough occupancy to fulfill our obligations to our investors and to our lender.
So I would add, just generally speaking, on that subject, that the densities within traditional office buildings are obviously on the rise. Everybody reads about WeWork and all the WeWork knockoff and competitors in the headlines and in the press. Certainly that is having an impact on office density. We believe that the co-working environment, which is still meaningfully less than 10% of all office occupancy in the United States, will probably peak out somewhere between 15 and 20%. And the reason for that is, as opposed to taking over and becoming 50 or 70 or 80%, and the reason for that is actually because of productivity and efficiency. And companies who are able to measure that will tell you that a blend of open and collaborative environment with traditional office space where people can go and concentrate on what they're doing is actually the best solution. And most people that have statistics and track that, which typically are large companies, would tell you that that blend is somewhere around 20 to 25% open and 75 to 80% kind of more traditional, at least cubes, if not offices. And that ratio actually will hold for remote working as well. Some of the big companies, we actually had a conversation a few years ago with Dell Computer, the head of HR, about this particular subject. And Dell has one of the most liberal policies. I actually have a cousin who works for Dell and frequently works from home. has one of the most liberal policies with respect to remote working. And they will tell you, based on their statistics, that about 1 in 4 people is more productive and more efficient in that remote environment than they are in the office, and 3 out of 4 are more productive and more efficient being in an office environment. So, again, certainly a trend that we watch and take into consideration. And as Andrew pointed out, we like to make sure that the properties that we invest in are properties that are attractive in and of themselves as a place to hang out, as opposed to the opposite, just kind of generic office building out in the far exurbs of some city. But we don't think that either of those trends, co-working or remote working, will rise to the point where they're more than kind of 20% or maybe max 25% of the entire workforce that's office related.
Thank you. That's really helpful for investors to hear. Next question is in regards to selling in 5 years. What if you don't find a buyer in 5 years? What happens to the loan? Can you continue to hold?
Sure, good question. As I mentioned, our loan is a 5-year loan with 2 1-year extensions, so we have up to 7 years for a loan period. And in the worst case is obviously if we think the terms of our loan any time during our ownership are out of market, because the loan is prepayable at any time at no cost, in terms of prepayment penalties, et cetera, at no cost. We can refinance the loan for a longer term, or if the capital environment yields a better rate. So we have ultimate flexibility over the next 7 years to have this asset under this existing loan, but then obviously we have the option at no cost to us to refinance if the time is right.
Thank you for clarifying. Next investor question is in regards to walkability. You mentioned the project was close to a lot of amenities, but if you could just speak to if you've looked into a walk score or any other metric for testing how walkable this office building is.
Yes, it's absolutely a walkable location. As I mentioned earlier, there's a tremendous amount of new retailers in the area. I highlighted a couple. Also, I mentioned that this is at a lighted intersection. Obviously, there's a walking path, as you saw earlier with the site plan, to that intersection over the creek. And the Starbucks within 100 yards away or less to grab a cup of coffee. So we absolutely is a walkable area. That's one of the primary reasons we like the asset. We like the basis because of its overall walk score. We actually were able to convince one of our existing relationship lenders to be a little bit out of their comfort zone and go below a LIBOR 200 rate, and because of the walkability of the asset, they were able to click under the LIBOR 200 to down to LIBOR plus 195, and that's a result of just the overall insular nature of the retail and the walkability of the asset.
Thank you. Next question is in regards to just what you find most exciting about this project, and then what you, conversely, what you feel is one of the bigger risks associated with it, coming from the lens of course, a CrowdStreet investor and what they should be thinking about.
Sure. We've got a diversified rent roll, so we don't in a very manageable rollover profile with the major tenants and the various other tenants. The historical performance of the submarket, if history repeats itself, has done very well with single-digit vacancies over the last 10+ years. We think that demand continues, considering there's no new construction, so there's not a lot of places for tenants to go. Downside, obviously, I mentioned earlier, we run a risk analysis. If rent growth stalls, we don't renew a major tenant. We still feel that our equity will be protected because of the overall location and the improvements of roughly $25 a foot. $2.5 million have been invested into the project comparative to its peers, which have not invested the type of capital tenant-facing capitals, like what we like to call it, in terms of new lobby, new restrooms. So it's very attractive to the current tenancy and potential new tenants to the project.
Great, thank you very much. I want to respect everyone's time. We have about 4 minutes, so I want to thank everyone for joining us. I just wanted to reiterate that the Invest Now button has been turned on since the commencement of the webinar. This webinar is being recorded and will be posted to the offering detail page where my cursor is in the next hour or so. So please look for it there if you want to share it or view it again. Offers due date for this project is June 5th. Funds due date is June 10th. Please also note the funding bar. As we've received multiple offers during the webinar, that's a good place for you to look to see how far along we are. If you have any questions at any point, maybe that did not get answered fully in the webinar, please use the questions box. The default is to send to Griffin Partners and CrowdStreet. We encourage you to use this default as we can help you as the investor get your question answered, whether that's transactional, it's probably best for CrowdStreet, or specifics about the deal that Griffin can help answer. You can also reach out to IR@CrowdStreet at any time. I will let Griffin Partners say any final words.
Well, one, we appreciate all the questions and the interest over the last several days prior to us going live with this webinar. We appreciate all your questions and interest. We're excited about our fourth offering with the Union Woods project in Salt Lake City, and look forward to closing this transaction in less than 20 to 30 days, 20 days plus or minus. And again, I'll reiterate, as Reed said, if you have any additional questions, asset-specific or transaction-specific, please feel free to submit those questions to us. We'll do our best to respond within 24 hours or less with a detailed response. Edward, did you have anything to add?
Nope. Thanks, everybody.
Great. Thank you, everyone. Have a good rest of your day.
Thank you.